Welcome to Novum Tempus, your go-to source for daily news and insights that matter. Today we're diving into a big decision by the Bank of England. They've just cut interest rates to 4.5%. What does this mean for you? Let's break it down together. We want to hear your thoughts. Drop your comments below and join the conversation. The Bank of England announced a significant decision on February 6, 2025. This move has been closely watched by financial analysts and market participants alike. They cut interest rates to 4.5%, down from 4.75%. This reduction is part of a broader strategy to stimulate economic activity. This marks the third rate cut in 6 months, reflecting efforts to navigate the UK economy through uncertainty and sluggish growth. The bank is keen on ensuring that the economy remains resilient. By adjusting interest rates, the bank aims to influence borrowing and spending patterns, impacting economic growth and inflation. Lower rates typically encourage borrowing and investing. This recent rate cut signals the bank's priority on economic stimulus amidst concerns about the UK's economic health. The decision is seen as a proactive measure to support the economy. The decision comes against a backdrop of mixed economic data and global uncertainty. Various economic indicators have shown inconsistent performance. While the UK has avoided a full-blown recession, growth remains fragile. The bank's actions are aimed at bolstering this fragile growth. The rate cut aims to inject confidence into the economy, encouraging spending and investment. It is hoped that this will lead to a more robust economic environment. The coming months will reveal if this move will steer the UK economy towards sustainable growth. Observers will be watching closely to see the impact of this decision. The primary motivation behind the Bank of England's decision is to stimulate the UK's sluggish economy. Economic growth has been weak, with a contraction of 0.1% in both September and October of 2024. November saw a slight uptick with 0.1% growth, still far below needed levels. Lower interest rates make borrowing cheaper for businesses and consumers, potentially boosting spending and investment. The bank believes the current economic climate necessitates monetary stimulus. This strategy carries risks, including potential inflationary pressures. However, the bank believes the benefits of stimulating the economy outweigh the risks. Success depends on factors like consumer confidence, global conditions, and government policies. The decision to cut interest rates was influenced by cooling inflation. Inflation, which had surged to over 10% 2 years ago, has been declining. In December 2024, inflation eased to 2.5%. This downward trend allowed the bank to focus on stimulating growth. Typically, central banks raise rates to combat inflation, but with inflation now manageable, the bank felt comfortable cutting rates. Critics argue that cutting rates while inflation is above the 2% target could reignite inflation. The bank acknowledges these concerns, but believes the immediate threat is economic stagnation. The rate cut is seen as necessary to avert prolonged weak growth. The bank aims to balance inflation control with economic stimulus. The rate cut to 4.5% was largely anticipated by financial markets. Market analysts had already factored in the likelihood of a rate cut, resulting in minimal initial market reaction. However, the longer-term outlook remains uncertain. Some analysts predict further rate cuts in 2025, potentially reaching 4% by year-end. Others believe the bank will adopt a wait-and-see approach, monitoring the impact before making further adjustments. Cutting rates too aggressively carries risks, particularly reigniting inflation. The coming months will be crucial in determining the direction of interest rates. Economic data on growth and inflation will be closely scrutinized. The bank's communication will provide insights into their future intentions. Alongside the rate announcement, the bank released updated economic forecasts, which have been eagerly anticipated by market analysts and economists alike. Previous forecasts projected GDP growth of 1.5% for 2025, a figure that was seen as optimistic given the current economic climate. Given recent data and global uncertainty, the bank is expected to revise this figure downwards, reflecting a more cautious outlook. The revised forecasts will likely paint a more cautious picture of the UK economy, highlighting potential risks and challenges ahead. Challenges include weak global demand, persistent inflationary pressures, and the ongoing impact of geopolitical tensions. Additionally, uncertainty surrounding the UK's future trading relationship with the EU continues to weigh heavily on economic projections. The forecasts remind us that the road to recovery is unlikely to be smooth, with numerous obstacles and potential setbacks along the way. The rate cut is just one measure in a complex policy landscape aimed at stabilizing the economy and fostering growth. The bank's forecasts are subject to change as new data becomes available, reflecting the dynamic nature of the global economy. They will continue to monitor developments and adjust policies as necessary, ensuring they respond effectively to emerging challenges. The decision to cut rates was made by the Bank of England's Monetary Policy Committee, or MPC. This 9-member committee meets 8 times a year to set interest rates based on economic conditions. Economists polled by Reuters expected the MPC to vote for a 0.25 percentage point cut. The consensus reflected the view that the UK economy required further stimulus. The MPC's decision likely reflects a near-unanimous vote. They believe the immediate threat is weak growth, not inflation. The rate cut signals the MPC's priority on supporting economic activity. Minutes from each meeting provide insights into the MPC's thinking and economic assessment. The recent rate cut highlights the delicate balance central banks face between maintaining price stability and supporting economic growth. This decision is not taken lightly, as it involves weighing multiple complex factors. In the current economic climate, with growth faltering and inflation running above target, the bank faces a particularly challenging balancing act. The dual mandate of fostering economic growth while keeping inflation in check is more difficult than ever. Cutting rates too aggressively could fuel inflation, leading to higher prices and reduced purchasing power. On the other hand, insufficient stimulus could result in economic stagnation, with businesses closing and unemployment rising. The bank must carefully weigh these risks and make informed judgments based on the current and projected economic outlook. This involves analyzing a wide range of economic indicators and trends. They will closely monitor indicators like inflation rates, wage growth, and consumer spending to gauge the effectiveness of their policies. These metrics provide crucial insights into the health of the economy. The coming months will be crucial in determining if the bank can successfully balance growth and inflation. Their decisions during this period will have long-lasting impacts. The success of their policies depends not only on their actions, but also on external factors beyond their control, such as global economic conditions and the outcomes of Brexit negotiations. The bank's ability to navigate this tightrope will significantly impact the UK economy and its citizens' financial well-being. Their expertise and adaptability will be put to the test in these uncertain times. Thanks for tuning in. At Novum Tempus, we're committed to bringing you the news that matters most. Until next time, keep questioning, stay curious, and never stop exploring. See you soon.